when you are actually trading in derivative market and you want to know how to use your knowledge in reality, you need to go with that application of what you have learned. And therefore my objective over here is not to make your knowledge just bookish knowledge so that you go and write exams. My objective is to train you in such a way that you parallelly understand the application of these concepts in real life. Now, what is this gross payoff? Gross payoff is basically just like gross profit. And what would be net payoff? Just like net profit. So there may be some benefit that the call option holder is getting by exercising the option. For example, suppose I am a call option holder, there is a call option and that call option has exercise price of rupees 100, but the prevailing market price of the share is rupees 120. That means there is a share whose market price is 120. I am a call option holder. That means I have right to buy this share at just rupees 100 because 100 was the strike price or exercise price. So by exercising this option, how much differential benefit will I receive? Rupees 20. That rupees 20 is the gross payoff of the option. But long back when I purchased this option, see, I just did not become that option holder by birth, right? By birth we are not option holder. We became option holder by an action. What was that? We bought this option. So in this example, I am the option holder. Definitely I would have purchased, I would have bought this option from the counterparty, that is option writer or option seller. Now when I bought that option, I must have paid premium to get that option, right? Because you will not get any option free. You will have to buy that. Suppose I paid rupees 7 to buy that option. So what will happen? When I have to decide whether I should exercise the option or not, I should not look at the premium that I have already paid in the past. Because if you have ever learnt costing concepts, cost that I have incurred in the past for purchasing this option, that is basically a sunk cost, correct? It cannot be considered as relevant to decide whether I should exercise the option or not. So in order to decide whether the option should be exercised or not, you just have to compare two things. That is what? Your options strike price and the prevailing market price of the share on the maturity date or on the expiry date, or I would preferably say on the date when you are exercising the option. So once again, let me remind you with what I just mentioned in this example. I am a call option holder. I have a right to buy a share at rupees 100. The same share is quoted in the market at 120. Today is the date when I have opportunity to exercise this option. When I exercise this option, I will definitely be benefited by rupees 20 as difference, because something whose price is 120, I am allowed to purchase it at rupees 100 only. Differential benefit that would come to my pocket is rupees 20. That rupees 20 is the gross payoff. But to get this benefit of rupees 20, long back I have incurred premium expense of rupees 7. Subtract that and arrive at the net payoff. The net payoff in my example will be 20 minus 7, that is rupees 13. So eventually at the end, we always have to look into what we gained out of that on an overall basis. When you take the whole picture, not the decision making scenario, your overall profit loss position, that time you have to consider each and every aspect, and that time you will always consider even the premium expenses to arrive at your net payoff or net profit. So you understand one thing, gross payoff minus the premium expense will give you the net payoff for the option holder. But imagine in case of option writer, the premium is not an expense, the premium is an income, because when the option contract was entered into, the option writer would have received this premium. So from the viewpoint of option writer, what you would do, you would take the gross payoff, to that you add the amount of premium income that you have received to arrive at the net payoff. So you first arrive at what is the gross payoff, and then from gross payoff to net payoff, the journey is very simple. If you are holder, subtract the premium. If you are writer, add the premium. That's all. Nothing much you have to apply as your common sense when you are converting the gross payoff information into a net payoff information. But it could be little tricky to understand what is gross payoff. That is why you have to be more alert while discussing what is gross payoff for any option. So first of all, you understand one thing, that when there is a call option, it has conveyed the right to buy. Some time back I gave you an example that the prevailing market price is 120, but I have right to buy the share at just rupees 100. Then and then only I find the option is exercisable, because my position goes in the money. Why? Because something whose market price is 120, I have right to buy the same at just rupees 100. That means market price is greater than exercise price. That time market price minus exercise price will give me the amount of gross payoff. That is also considered as intrinsic value of that option. So that will be intrinsic value of that option. So that day I will approach the option writer, that is the counterparty, and I'll ask that counterparty, come on, pay me the differential of rupees 20. That party will have to pay me the differential of rupees 20. So simple logic what you should apply is, when does a call option get exercised? Fact number one, a call option, first of all, any option will be exercised only when the option holder's position is in the money. So when will an option holder find his or her position in the money with respect to a call option? A call option that conveys the right to buy, the position of the holder will be in the money only when the prevailing market price is greater than the strike price or exercise price. So I am plotting the scenario this way: if market price is greater than exercise price, the call option is in the money. That time difference between the market price and exercise price will be the option's value or intrinsic value of the option, and the same thing is termed as gross payoff. If I am the holder, I will receive that value. If I am a writer, I will have to pay that value, correct, to the counterparty. Thereafter, from gross payoff, how do you arrive at net payoff? I have already explained to you. So you should be clear with one thing, that a call option is exercisable only and only when the market price is greater than exercise price. Let us talk about a put option. Imagine I am holding a put option. That means an option that is conveying to me right to sell a share, suppose at rupees 500. Prevailing market price of that share is 525. Then I will not exercise my right to sell the share at 500, right? What is the condition required for exercising a put option? Because I have a right to sell at 500, I will use that right, I will exercise that right only when the prevailing market price is less. If prevailing market price is suppose 480, then it makes sense for me to exercise my right and sell the share at rupees 500 instead of selling it at open market price at 480. So something whose price is prevailing as 480, but I have right to sell it at 500, I will definitely exercise my right. That means the condition to make a put option exercisable is that the market price should be less than the exercise price. So condition for exercising call option, market price should be greater than exercise price. Condition for exercising put option, market price should be less than exercise price. So when market price is greater than exercise price, in case of call option, it is in the money and it will be exercised. So when it is a case of call option and the market price is equal to or less than the exercise price, both ways it will not be exercised. If it is not exercised, the gross payoff will be 0. that means the intrinsic value of the option will be 0. So be very clear with when you are dealing with these options. What I'll do is I'll give you very important notes. Please write up these notes systematically. First we will deal with what happens with respect to gross payoff for both the parties in case of a call option, and then we will apply our understanding to put option as well. So first, the basic notes about gross payoff. A call option is exercised by the holder only when the prevailing market price is higher than strike price, that is market price should be greater than the exercise price. A put option is exercised by the holder only when the prevailing market price is lower than the strike price, that means market price should be less than the exercise price. Gross payoff for the option indicates its value on the date it is exercisable. It is also known as intrinsic value of the option. Let us move ahead, and now we talk about call options in the first place. When you are talking about call options, there can be two possibilities. Possibility number 1, that market price is greater than exercise price. Possibility number 2, that market price is less than or equal to exercise price. Look at one thing, I have put greater than sign over here and less than or equal to sign over here. Why? Because question is, when will a call option be exercised? A call option will be exercised only when the prevailing market price is greater than the exercise price. Under any other circumstances, it will not be exercised. That is why less than and equal to sign comes this side at the right hand side. At the left hand side, we have taken market price greater than exercise price. Now you tell me, when with a call option you find this scenario, what will be your action? You will exercise the call option, and if it is this scenario, your call option will not be exercised. So when your call option is not exercised, its gross payoff or the intrinsic value will simply be 0. But when the call option is exercised, its gross payoff or intrinsic value will be the difference between market price and exercise price. So it will be market price minus exercise price. Note one thing very clearly, that because market price is greater than exercise price, market price minus exercise price will give you a positive value, and that will be the intrinsic value or gross payoff of a call option. On the other side, if the option is not exercised, its gross payoff or intrinsic value will simply be 0. Now, once you have understood how to determine the intrinsic value or gross payoff of any call option, that is MP minus EP, you know what you do is you work out what will be that MP minus EP. Whatever be that value the holder will receive and writer will have to pay. In other words, when you compute payoff from the viewpoint of the option itself, it is MP minus EP for the call option when exercised. When you are holder, you will receive that value which is MP minus EP. So your cash flow is a positive amount of cash flow because you are going to receive it. But when you are a writer, that cash flow will go out of your pocket. That means MP minus EP will go out of your pocket. In other words, if you have to identify what will be the cash flow for the option writer, that is a call option writer, it will be minus of MP minus EP within brackets. When you open the bracket, it will be minus of MP minus EP. So on opening the bracket, the minus sign gets applied to MP as it is. So it will be minus MP, and then minus of minus EP will become plus EP. So when you finally open the bracket, it will be minus MP plus EP or EP minus MP. Why I am discussing this in details? Because gradually at later stage you are going to deal with option strategies. If you find this whole thing not clear, you will be getting extremely confused when you land up at option strategies. But if you are finding this thing extremely clear, you will actually enjoy the whole discussion on option strategies, and that will actually be something worth learning from real life viewpoint. So to land up at that situation, let us first complete this part. So here we would say, in case of your intrinsic value determined as MP minus EP, for the holder it will be plus sign outside the bracket. So this MP minus EP will come in the pocket of the holder. That is why outside the bracket we have placed a plus sign. So on opening the brackets, it remains as it is, MP minus EP. However, in case of writer, what will happen? It will be minus of MP minus EP. So MP minus EP is the intrinsic value of any call option when exercised, and if you are the writer, you will have to pay that value from your pocket. That is why a payment or a negative cash flow will be identified with a minus sign over here. So minus of within brackets MP minus EP, when you open the bracket, it actually becomes EP minus MP. So now with this understanding, let us move ahead with put options. Now let me first talk about these put options, and then only I'll put that display on screen, because otherwise you will not pay attention on what I am saying. You will start actually writing the chart. Why students do that, I have never understood in my life yet. That when I say that I'll give you time to write, they would still want to write when I'm talking. So when I'm talking, just listen to me. Now what happens with put options? Put options convey a right to sell. So suppose I am holder of a put option, and that put option gives me right to sell a share, say at rupees 300. So 300 is the exercise price or strike price. I have a right to sell the share at 300. Prevailing market price is 320. Will I exercise my option and sell the share at 300? Answer is no. I will not do that. I will exercise a put option only when the market price is lower than the exercise price. So in that example, if the exercise price is 300 and the prevailing market price is suppose 272, then it makes sense for me to exercise my right to sell the share at 300, because then I'll be getting some differential benefit. So a put option holder will exercise a put option only when the market price is less than exercise price. So the other possibilities where the put option should not be exercised are the possibilities where market price is equal to exercise price or market price is greater than exercise price. So equal to and greater than part we will keep another side. One side what we will consider will be a situation where market price is less than the exercise price, because that is the scenario where a put option will be exercised. Now when a put option is not exercised, its gross payoff or intrinsic value is going to be 0. But when it is going to be exercised, its payoff, that is the gross payoff or intrinsic value, will not be MP minus EP, because MP market price was actually lower than the exercise price. So the worth of that option is not MP minus EP, because if you do that, it will come to a negative value. So worth of the option will be EP minus MP, that is exercise price minus market price. Once you land up at that value, that is the value of the option or the intrinsic value of the option or the gross payoff of the option, and then it is very simple to identify. If you are holder, you will receive that value, means a cash flow with a plus sign. If you are a writer, that cash will go out of your pocket, so it will be a cash flow with a negative sign. Then to identify what happens to the holder and writer in terms of their respective payoffs, it is very simple. You have to first land up at the correct intrinsic value of a put option. So let me now help you with this chart clearly, and I know you were so eager to write it down, so now I am giving you all that opportunity. So put option split into two categories: market price less than exercise price. This is one scenario where the put option will be exercised. The other scenario where the put option will not be exercised is when market price is greater than or equal to the exercise price. Now, when the put option is not exercised, its intrinsic value or gross payoff will be 0. So we are not concerned with that. But when it is exercised, its intrinsic value will be exercise price minus market price, EP minus MP. You may also call it as strike price minus market price. Now, the other side, we know that its intrinsic value or gross payoff will be 0. Now, when you have found that at the time when the put option is exercised, its intrinsic value is EP minus MP. If you are holder, you will receive this value, means EP minus MP when put within brackets. Outside the bracket, I will put a plus sign, and if you are a writer, outside the bracket, I will put a minus sign. And therefore, when you look at this minus of EP minus MP, when you open the bracket, it actually becomes MP minus EP. Let us move ahead and learn how to apply these concepts in given situations, and we get started with question number 7. Let us read this question. Type of option is European call option. Strike price is rupees 56 per share. Call option premium is rupees 8 per share. You are required to make a payoff table and indicate gross as well as net payoff for the option holder at different market prices. Determine the break-even point wherever applicable. Show the payoff graph. Also provide the outcome from the viewpoint of call option writer. So friends, fact number 1, we have been given information about a call option, which is a European call option. So with a strike price of 56 means this option conveys the right to the holder to buy the share at rupees 56. Premium paid is rupees 8 per share. Fine. How to make payoff table and how to present the payoff graph, that is what we have to mainly learn over here. An important thing is, first they have asked all these calculations from the viewpoint of option holder, and then they have also asked from the viewpoint of option writer. So we will first take the viewpoint of option holder, and then we shall consider the viewpoint of option writer. So the solution begins from the viewpoint of option holder. Let me explain you how would you present the solution. What you would do is first write the basic things. Type of option is the European call option. Strike price is rupees 56 per share, which we are also mentioning as exercise price. And then when you are presenting the payoff table, this would be a typical format. Whenever in examination you are required to present a payoff table, always follow the same format, whether it is call or put option or whether it is a case of holder or writer, the format of the table would remain same. Now, important thing is, sometimes in examination, they would mention different types of market prices. Here they have not given any indication. So what we will do is, we will just draw 3 lines. First line is for market price less than 56. Second line, when market price is equal to 56. Third line, when market price is greater than 56. Now, action to be taken by holder. Never to forget, it is a case of call option, and the condition to exercise the call option is when MP is greater than exercise price. So exercise price is 56. Only when market price is greater than 56, the call option will be exercised. So this column will be filled by simply writing lapse for the first 2 lines, and in the last line where this condition exists, you will exercise this option. So obviously, when the option is lapsed, the gross payoff will be 0, right? And when it is exercised, it will be MP minus EP. Because this is a case of option holder, the value of call option will always be MP minus EP, and for the holder, because that value is coming in the pocket, it will remain MP minus EP, that is in this case MP minus 56. Now friends, when you are required to prepare the payoff table, gross payoff is what we have learned by far. One extra thing what you will have to do is, this is a case of option holder. So whatever premium is involved, it is an expense. That premium expense you are writing down over here. Whether it is any market condition, the premium that you have paid is definitely rupees 8.
one thing as a point of caution. To decide whether the option should be exercised or not, we did not consider this 8 rupees of premium paid by the holder. But when you have to determine the net payoff, that is your final amount of profit or loss, obviously you have to consider all gains and losses, all incomes and expenses. Your gross payoff was 0, nothing you could obtain, but premium that you have paid is rupees 8. So net payoff over here will be minus 8. In simple words, to compute net payoff, it will be gross payoff minus premium expenses. So for the first line, 0 minus 8 minus 8. Second line, 0 minus 8 minus 8. Third line, MP minus 56 minus 8. So it is minus 8 and MP minus 56 minus 8, which will be equal to MP minus 64. So MP minus 56 again minus 8 will make it MP minus 64. Now the next question is, how would you determine the break-even point? Break-even point arises when the net payoff is 0. Now boss, understand, when MP is less than 56 or equal to 56, there is no chance that you get payoff other than minus 8. So here, both of these places, break-even point is not applicable only. But over here, when the net payoff is MP minus 64, you need to equate MP minus 64 with 0. Break-even point simply means no profit, no loss, right? So when you equate the net profit or net payoff with 0, you will be getting the break-even point. So MP minus 64 should be equal to 0. So what will be the value of MP? When you shift minus 64 to the right hand side, you will be getting MP equal to 64. So you would mention over here and here, not applicable, not applicable, and here MP equals to 64. Friends, I have explained to you this whole thing. After a while, I'll also let you practice this right in front of me. But friends, don't simply copy this right now. I would want you to, carefully apply this concept and fill up this table on your own right now also. And then you may check on the screen whether you have done correctly or not. Alright, let us move ahead and learn how to present the payoff graph. When you have to present a payoff graph, draw the two axes where x-axis will indicate the market price and y-axis will indicate the net payoff. What you should do on x-axis, plot two prices. One is 56 and another is 64. So this is basically the strike price that is plotted on x-axis, and another is the break-even point. On the y-axis, you should plot the outcome in terms of net payoff, what we have seen for the first two lines, that was minus 8. So minus 8 is the net payoff when the market price is less than or equal to 56. So friends, what will happen? Imagine on x-axis, when we have taken market price being anything less than 56 or equal to 56, the option will not be exercised, and so the premium that you have paid, rupees 8, will be lost. So your constant net payoff will be rupees 8 negative up to from 0 to 56, correct? Now what happens? When the market price is above 56, you start exercising your option and your payoff from minus 8 starts rising up. By the time it is coming to 64 as market price, you will achieve break even, and then with the increase of further market price, the line will go on rising up like this. So when you present the payoff graphically, it comes exactly this way. So your market price, anything below 56 or equal to 56 will give you a constantly negative 8 rupees payoff, and between 56 and 64 the loss starts reducing. At 64 it is break even, and let us mention this, that at 64 it will be break even, and beyond 64, as and when the market price rises, the payoff will also rise. Alright, let us try to understand something very, very important over here. So you are finding this payoff graph typically for a call option holder. Look into one thing. With respect to call option holder, if the market price is falling, the call option holder will be incurring a loss. When the market price is rising, call option holder will be making profit. That means point number 1, call option holder will be making profit when the market is rising. That means when the market is bullish, the call option holder will make profit. That means why someone would have taken a call option, why someone would have, become holder of a call option. The answer is very simple. That party, the call option holder, must have bullish sentiments. Second thing, you see, you have a limited loss, right? Your loss will not exceed beyond 8 rupees. This is limited loss for you. And look into the profit potential. You have unlimited profit, right? When you cross this break even with more and more market price rising up, the payoff will go on rising without any limits. So there is no limit to the profit that you can make, but there is definitely a limit to the loss. The loss is restricted to the amount of premium paid. Third and the last thing, the break-even point for the call option holder, 64, you may directly compute this as 56, that was a strike price. To that you add premium. So 56 plus 8 will give you directly 64. In simple words, break-even point for the call option holder is always strike price plus premium. So friends, these 3 important points I am showing on screen. Please note down. Alright, let us move ahead and take the case of option writer. So viewpoint of option writer. So what we do again is write the basic things, type of option, exercise price, and when you prepare the payoff table, I told you the format remains same with just a little bit of difference because this will be a case of option writer. So you would notice one main thing, that is instead of premium expense, I have written over here premium income. This column based on whether it is income or expense would highlight the case of whether holder or writer. So obviously we have 3 different ranges of market price, same thing, less than, equal to or greater than 56. Now action to be taken by holder. Mind it, even though it is a payoff table that you are preparing for the writer, but action cannot be taken by the writer, action will be taken by the holder. So the same thing will happen, lapse, and exercise. Gross payoff, for lapse it is always 0. When it is being exercised, for the holder it was MP minus 56 as gross payoff. For the writer it will be 56 minus MP. Why it is like that? I have explained you already. So it was basically MP minus 56 as the value of the option, and for the writer the value will go out of his pocket and therefore it will be negative of MP minus 56. Eventually it will become 56 minus MP. So 0, 0 and 56 minus MP. Next thing, premium income will be rupees 8 for all cases. So for option writer, you would see that gross payoff plus premium income will give you the net payoff. So it is 0 plus 8 as 8, 0 plus 8 as 8, and 56 minus MP plus 8 will give you 64 minus MP. Coming to break even point, at these 2 lines, the net payoff is always going to be positive 8 rupees. So this place, the break even is not applicable at all. Break even will apply only in this case when MP is greater than 56. Break even means the net payoff should be 0. That means 64 minus MP will be equated to 0. Again, when you solve that equation, that is 64 minus MP equal to 0, you will eventually get MP equal to 64. So what we do over here, I told you not applicable, and MP equal to 64 in the last line. Alright friends, let us move ahead and draw the payoff graph. So this being again a case of call option, I told you, you would plot the same things over here. That is, you will plot on x-axis the market price, which will be having 2 points to be plotted, that is 56 and 64. 56 is the strike price and 64 is the break-even point. So on the y-axis, you will plot only one thing, that is the positive payoff. When the market price was less than 56, the positive payoff was 8. So now look into what will be the case of option writer over here, that is call option writer. Any market price which is less than or equal to 56, the option is going to lapse, and whatever premium income has been received by or earned by the option writer will become the net payoff, because the gross payoff will be 0 and premium income will be 8. So constantly there will be 8 rupees of payoff for any market price being less than or equal to 56. Then from 56 to 64, the payoff will start reducing, though it will be positive, but it will reduce. At 64, you will again arrive at break even, and beyond 64, you will start incurring loss. So the payoff goes this way, constant 8, then decline to break even, and then a case of loss. So here is your payoff, and secondly, we would identify 64 again as break even. Before we move ahead, let us discuss some important points. Now the case is of a call option writer. Look at one thing, the strike price was 56. The call option writer is making profits when the price is below 56. That means when the prices are falling, the call option writer is making profits. In other words, call option writer must had bearish sentiments before this party would have entered into the contract. Second thing, break-even point for even the call option writer in this case is 64, and what we have discussed earlier, 64 is nothing but 56 plus 8. This 56 indicates the strike price and 8 is the premium. So the call option writer will also experience the break-even, which will match with strike price plus premium. Lastly, you see there is a limited amount of profit over here, but if the market price starts moving up, this decline continues and it will go on and on. That means there is chance of incurring unlimited amount of loss for the call option writer for making just a limited amount of profit. So let us do one thing. Let us write up these important points also. I've explained you already. Quickly take note of this.
Time for us to move ahead and look at the other scenario. What if the case is of a put option, and that is what we are going to cover in question number 8. Let us read this question. Type of option is European put option, strike price 56, put option premium is rupees 8, and same types of requirements for option holder, as well as they have demanded the viewpoint of option writer. So more or less same thing. We find one thing, that this is not call option but a put option. So let us see how to solve this question. We first take the viewpoint of option holder. So it is a case of put option holder. So first we would mention that the strike price is 56 per share, and then we make a payoff table. Payoff table format would still remain the same. And this being a case of option holder, in premium column we have written very clearly it is a premium expense. Same three things, three types of price ranges: market price less than 56, equal to 56, and greater than 56. My friends, now I am willing that you should fill up this whole table from your side before I show you the solution. Let us check whether you were correct with your table fill up. So first thing first, put option, correct? This is a case of put option, and put option will be exercised only when market price is less than strike price. That is when market price is less than 56 in this case.
So here it will be exercise, and then in the other two lines lapse and lapse. When put option is exercised, the gross payoff for the holder will always be EP minus MP, that is strike price minus market price or exercise price minus market price. In this case, it will be 56 minus MP, and when it is not exercised and lapsed, it will be 0 and 0. Premium expenses rupees 8 in all cases. Net payoff will be gross payoff minus premium expenses. So in the first line, it will be 56 minus MP minus 8, that gives you 48 minus MP, and here it will be 0 minus 8 and 0 minus 8, which will be remaining as minus 8. Obviously, when you come to break even column, over here in the last two lines, the break even is not applicable. Over here, to arrive at break even, you have to equate the net payoff to 0. That means 48 minus MP should be equal to 0. When you solve that equation, 48 minus MP equal to 0, MP will be 48. So MP equals to 48 will be the break even in the first line. In other two lines, the break even is not applicable. So along with this explanation, I'm sure you would have understood the whole thing, and I'm also sure that before I have started this part, you would have done this whole thing correctly on your own. So let us move ahead and make the payoff graph. So again, on x-axis we would take market price, and on y-axis we would take the net payoff. We will again plot two things on x-axis, that is the strike price 56 and the break-even point, that is 48. Now friends, you would have noticed one thing. This is a case of put option holder. Put option holder is going to make money when the prices are falling, right? When the market price is less than or equal to 56, then the put option holder is going to make money. What happens when the price goes beyond 56? The option will be lapsed and the payoff will be simply minus 8. That is what we have identified, right? So this minus 8 of payoff will not start this time at early stage, but this minus 8 payoff will start after the price is 56. When the price is less than 56, that is less than the strike price, the payoff will be positive over here. And when the price is 0, if you may substitute the market price to 0, the net payoff will be matching with break-even point, that is 48. Friends, you might be wondering what are these lines, right? Now let me explain one thing. These are called breakers. If you see, on scaling basis, the distance from 0 to minus 8, and here this short distance we are considering as 0 to 48 and 0 to 48. So basically in the whole graph there is no parity in the scaling, and to overcome that disparity of scaling, we put breakers so that we are shifting our focus directly to this line. That means scaling in this part is being overruled. Now, so what we do is the payoff from 56 onward will be minus 8. But before that, it will be a better payoff for the option holder. At 48, there will be break even. So the payoff line would be this way as minus 8 from 56 onward. Between 48 and 56, it will be showing this trend because it has to touch to break even when the price is coming at 48. The net payoff would be 0 over here. And when further the price reduces, the payoff would increase. By the time the price comes to 0, the payoff would be exactly matching with the break even. That means at 0 as market price, the net payoff will be that same amount which was break even. So the line goes this way. You may please note it down, and then I give you some important points. You see what is happening. Put option holder's case. Put option holder is making profits when the market price declines. That means put option holder must had bearish sentiments before entering into such contract. So put option holder has bearish sentiments. That is one thing. Secondly, the break-even point is 48, which was basically 56 minus 8. That means strike price minus premium will give you break-even point. So for the put option holder, the break-even point will always be strike price minus premium. Third important point, this put option holder will always make a limited loss where loss is limited to the amount of premium paid, and will also make a limited profit where the amount of profit is always going to be limited to whatever was the break even. So in this case, break even is 48. Maximum profit that the put option holder will earn will be also rupees 48. So I have discussed these points. Please take note of the same. Alright friends, let us move ahead and take up the case of option writer. So this is a case of or viewpoint of a put option writer. So same example from the viewpoint of option writer. So same format of payoff table, and again same thing. You should fill up this whole table from your side before I show you the solution. So let us check whether you have done it correct or not. So 3 different market price ranges. Don't forget, this is a case of put option writer. Action though will be taken by the holder only. So it will be exercise, lapse and lapse. Gross payoff for a put option writer will be MP minus EP, that is MP minus 56, and where the option is getting lapsed, the gross payoff will be 0. Because it is a case of option writer, premium income will be recorded, and premium income when added to gross payoff, you get the net payoff. Break even will again be MP equal to 48, and in other 2 cases it is not applicable. Let us move ahead with the payoff graph. This time put option writer will make profit when the market price is rising, correct? When the market price is rising, put option writer will make profit. And what you can see, beyond 56, put option writer is making profit, but a limited amount of profit, that is rupees 8. Below 56, the payoff starts reducing. 48 is the break even. So at 48 of market price, the net payoff will be 0. And then if the market price further falls towards 0, the payoff will also start reducing. But there is a limit of this loss. The loss is limited to the exact amount of break-even point. So 48 is the break-even point. Let us discuss again some important points. Point number 1, the put option writer is making profits when the market price rises. That means put option writer has bullish sentiments. Secondly, there is break even arising at 48, and 48 is nothing but 56 minus 8. That means strike price minus premium will give you break even for the put option writer. And finally, third and last important point, there is a limited profit and there is a limited loss. So limited chance to earn profit of just rupees 8. That means profit is limited to the amount of premium income. Whatever be the amount of premium, that is the limit of profit, and whatever be the break even, that becomes the limit of the loss. So if the price falls below 48, obviously the price may theoretically fall to what? Maximum 0. In such case, with each rupee of price fall, your payoff will also decrease by 1 rupee, and finally what you get is maximum loss as 48 and maximum profit as 8. So let us even write those important points.
Let us move ahead and now take up discussion on concept number 6, that is net payoff and break even. Though I have already explained you, but let us write quick notes on this. The net payoff for option holder is always equal to gross payoff minus premium. The net payoff for option writer is always equal to gross payoff plus premium. Break-even point is arrived at when net payoff equals to 0. So break-even point for a call option, whether you are holder or writer, it will be strike price plus premium, and break-even point for a put option, whether you are holder or writer, it will always be strike price minus premium. So let us just move ahead and now write notes on outcome of call option that is given under concept number 7. So holding a call option provides the holder an opportunity to make unlimited profits when the market price rises up, with the risk of limited loss when the market price falls. Such loss is limited to the amount of premium paid. Let us look at the other aspect, that is what will happen as an impact of writing a call option. Writing a call option creates for the writer a chance to incur unlimited loss when the market price rises up, with an opportunity to make limited profit when the market price falls. Such profit is limited to the amount of premium received. The call option holder makes money in a bullish market. The call option writer makes money in bearish market. Let us move ahead, and now we talk about concept number 8, that is outcome of put option. So holding a put option provides the holder an opportunity to make limited profit when the market price falls. Such profit is limited to strike price minus premium, with a risk of limited loss when the market price rises up. Such loss is limited to the amount of premium paid. Let us move ahead and look at what will happen as an impact of writing a put option. There will be possibility of limited loss when market price falls. Such loss is limited to strike price minus premium, with an opportunity to make limited profit when market price rises up. Such profit is limited to amount of premium received. So put option holder makes money in bearish market and put option writer makes money in bullish market.